Hello, Allie and Tanner. I got to talk to Tanner a little bit. What I'm going to do is a portfolio MRI, is what I call, where I really dig in and analyze what you guys have in your Roth IRA investment wise and how it reaches all the asset classes. I'll try not to make it very long, but try to hit the high points. And if you guys have any questions afterwards, you can reach out to me. Allie, just so you know, I've talked to Tanner a little bit, but we're kind of have very similar situations. My wife's a C-17 pilot and commander on active duty still. I'm a reservist flying the C-17, flown for FedEx for about 8 years, and I've been a financial advisor for over 11. I call myself the pilot's advisor because obviously I know not only military but also the FedEx 401k very well, investing. I had an uncle that was in the business for 40 years, so that's how I got in. Anyway, these are the mutual funds you guys are invested in. What I look at is the expense ratios, the fund turnover, because this tells me how much they're actively managing your account, and stock picking, which is not necessarily a good thing. And then also the holdings here tells me how diversified the fund is. So I won't go into the details of these because I'll show you the net result. I want you guys to remember this 8,000 different positions here because this is a bond fund, and I want to subtract that out of the actual positions to see how diversified you really are. And we'll look at that right now. The average portfolio that I look at has between 2,000 and 3,000 positions. As you can see, you guys are showing 11, but I want to subtract out the 8,000 on that bond fund to where you guys are pretty much right in that range, just over 3,000. The portfolios that I build have over 17,000 positions, which are truly globally diversified. Over 17,000 positions, 46 countries, and hitting the asset classes in the right percentage. Another thing I look at with these mutual funds is how much overlap is there. I looked at this with your portfolio. It's really not that bad with the overlap. And what overlap is basically, so say you own American Express here. Well, all three of those mutual funds own American Express, and they're actively managing that account, but they're not talking to each other. So on any given day, one professional money manager might be selling it while the other one's buying it. And ultimately, that costs you guys money. So I apologize. That's my people texting me and emailing me. So that's going to be going on for a little bit. So forgive me. So anyway, there's not a massive overlap problem, but you can see, there's three different mutual funds here. As I go through all the different positions. So it's not a major problem, but it costs you money. Ultimately, you want to have efficiency in your portfolio. And here's the big number that's going to show you guys. Okay, this is 28 pages of data. I'm hitting the high notes for you guys, so this isn't 30 minutes long. So this green is your portfolio, and as you can see, you have about 10% fixed income or bonds. So this is your cash or bonds. You want this to be in short-term fixed if you don't have it in cash, so you're kind of missing there, and I'll show you why later. But the bottom line is you have 90% stock, 10% bonds. And so what we're going to do is we're going to compare apples to apples and oranges to oranges. So we're going to compare it to this aggressive category, which is a 95-5 portfolio, because that's the most like the one that you have. I want to focus on the equities because this is a Roth IRA that it's long-term money you're not going to need until you retire, so you want to be aggressive. And what I see here is you have a lot of it in U.S. large cap stock, almost 63%. You have some international, almost 20%. But you don't have anything in large value, small, or small value. You can see these percentages here, nothing in small international. Using Nobel Prize-winning research and statistical data, there's enough out there to get the right amount of exposure to each asset class. You want to have 30% of small international, okay? And these are the percentages of the U.S. Large and small value. So you can see where you're missing, and I want to show you the numbers on that. This is the way that I would invest your money. This is what Nobel Prize-winning research states that you should. And the net result of the long term is you make a lot more money. It's not linear. It doesn't happen every single year. But over the long term, you get that extra 1% to 2% per year. And here's what it turns out to be. So if we looked at the last, and I got to go back and see what I pulled it from. So from 1973, so we're looking at a 40-year period. If we kept investing the way you're investing right now, and that also assumes that we don't change anything, $100,000 in your portfolio would have grown to be $8.6 million. Whereas if you did it my way, getting those extra 1% to 2% per year, it'd be over $20 million. Okay, And this is what actually happened. This is not made up numbers. This is looking back on history and looking at asset class returns. So now that I've shown you the numbers, I like to show this up front because it gets people's attention. Now that I've shown you the numbers, I'm going to show you why there's that difference, why you've missed out on it, and it's that small and small value, but I want to show you the numbers academically really fast. Excuse me. There's rules to investing. The main rules that you want to know is you want to own equities, you want to rebalance. You can't stock pick, you can't time the market, and you can't track record invest. I have data and slides on all that stuff if you want to dig into each one of those. But if we just assume that for now, that you're going to hurt yourself if you do any of those things, we can watch this. So anyway, all this is stating is if you have all large U.S. stocks, you'd get an over 10% return with a standard deviation of 16.47. The standard deviation is basically how much risk you're taking. And what this is showing is if you add in some small and some small international, if you keep adding it in, you can see that your return actually goes up and your risk goes down. This is modern portfolio theory. So we want to be globally diversified. The more diversified we are, we increase our return and lower our risk. So modern portfolio theory, that's what we want to do. But here's what I really want to show you is something called the three-factor model. And this is what makes up that big difference. Eugene Fama and Kenneth French, Nobel Prize laureates for their data in this. And so I'm just going to ask you, okay, the first one's the market factor. Which one's going to give you a higher rate of return, a stock or a bond? Well, everybody pretty much knows this one. It's going to be a stock. The equities are riskier, but they historically provided a higher rate of return. So over the long term, S&P 500, so this is just looking at large cap U.S. stocks, but 10% return, there's a standard deviation. If you're investing in bonds or T-bills, you're not going to get it. You're barely keeping up with inflation. But these next two factors are the ones that make the big difference. The size factor. Which one's going to give you a higher rate of return, a small or a large? Well, the data suggests that a small stock is. And you can see almost a 2% premium here. They're riskier, but historically have provided a higher rate of return. So what I'm saying here is own all the large cap. We want to own all of the S&P 500. We don't want to pick out just 23 of them and try to stock pick. We want to own the market because that's where the efficiency is. But we also want to get exposure to U.S. small stock, international small, etc., because we know that small stocks are going to give a higher rate of return over the long term. And then the last factor, the value factor. So this is basically high book to market value stocks. They're riskier, but they provide a higher rate of return. Here's the numbers, another 2% premium. Okay, so the 2% premium over the long term, we know this is long-term money, so we want to own that, have exposure to that. So I'm going to go back real quick and look at your portfolio so we can see the difference of what we're looking at. So I'm going to roll back up. Here's the numbers again. Remember 8.6 million versus 20. And I'm going to roll back up here. And this is all where the difference is. You see right here. You guys don't have any exposure to small value, large value. There's a small there with no exposure. Whereas if you increase those percentages and have exposure to those asset classes that historically have a higher rate of return, you're going to make more money. One last thing I'm going to show you, and I know this is fast. If you guys want to dig into the nitty gritty on it, feel free. Read this. This is Harry Markowitz. I want you to read the top here. And Harry Markowitz won the Nobel Prize in 1990. This is the Markowitz efficiency frontier. And basically what we're going to do is we're going to plot what you guys have in your portfolio versus the efficiency frontier. I know you can press pause here and probably read that, so I'm going to keep moving on. But your numbers are right here. Okay, so return, 10% standard D, 15. Let's plot this, 15, 10. And this is if you didn't change anything. The reality is you're probably not getting anywhere close to 10% return because they're actively managing all those mutual funds, which are costing you money. So we want to stop that active management, okay? No surprise you're somewhat near the S&P 500 because 63% of your portfolio was in U.S. large cap stock. All right, so what this is basically saying, if you're happy with that 10% return, we can come over to the efficiency line. If we build you an efficient portfolio, you can drastically reduce your risk. And conversely, if you're okay with that amount of risk, which you might be in this portfolio since it's a Roth IRA retirement account, you can come up to the line here and expect a higher rate of return, which we all want. So this is all about building an efficient portfolio, doing it from an academic approach, not stock picking, not market timing, not track record investing, and building a truly globally diversified portfolio. And I think you guys would, nobody wants to argue with this. I mean, it speaks for itself. 8.6 million versus 20 million. That shows you where the problem is in your portfolio and being truly globally diversified. So once again, these are your mutual funds. I think I've gone over everything I want to go over just for this short video. If you guys have questions going forward or you want me to help you fix this problem, I can. But feel free to reach out to me. I know we're all busy, which is why I made this movie recording, so we didn't all have to find a time where we could talk. But going forward, that's something that we could easily do. So just let me know. I'm here for you, and I will talk to you guys soon. Take care.